Hello traders, Gary Wagner here, just before 10:20 in Honolulu, 4:20 in New York. It is Friday, happy Aloha Friday as we say on the islands, August the 5th, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine it with trending markets to give you an overall sense or feel for activity that occurred this week in the markets, as well as our forecast for next week. Incredible ending to the week. Jobs report coming out much stronger than expected. We'll talk about that as we get into the show, but that had tremendous effects, ripple effects across the markets, across the board. Precious metals under tremendous pressure. Dow Jones Industrial Average, tremendous growth. S&P NASDAQ, new record historical contract highs, a strong dollar, and crude oil in essence unchanged on the day. First, let's take a look at gold. Gold down about $25 on the day, closing at $1342.60. This is our continuous COMEX contract based on December month. It opened at 67, traded to low of about 40. The high, of course, was prior to the jobs report, percent on the day, $25 lower. Silver also getting hit pretty hard on the day. You can see that right here, off about 3% on the day, 1969, low 1970, the high 2043. Of course, we did have an active trade in gold. We'll go through that in detail during the show, but in essence, we got in at roughly 1338. That is basis December contract. We had trailed our stop up just about midweek, got out with a $6 gain on the trade. Not very much profit, but certainly not a loss. And we'll talk about that as we pull up our first chart. So traders, absolutely no doubt, a very strong downside move in the gold market. We're looking at a daily chart, standard candlestick format. You can see the day's events kind of unfold with this long red candle. In other words, it opens up in the high 60s area. The 1360, 72 would be this top tail here. It closes near the lows of the day at 1344. And of course, we did take a play in the market, getting on a long position just following the conclusion of the FOMC meeting. That was last week, of course, raised our stop and we're stopped out today, as I said, with about a $5 or $6 gain on the trade. That being said, the real question has to be, have we seen real damage, long-term or short-term chart damage within the models that we use? And does this throw any of that out of whack? And I have to tell you that the rough answer is no. Consider this. When we look at the actual size and scope of this most recent rally, and when I talk about this rally, I am beginning at the end of last year, beginning of this year, when the market really tracked off of these lows sitting at about 1050, 1060. So we've seen this market move in essence from 1060 up to about, 1380. A tremendous move to the upside over a $300 gain. During that time, we've had real periods of corrections. We've had real strong rallies. And so the way that our basic count looks right now, and this is what I call our short count, because I am going to bring our long count into the picture here, but we have our wave 1, our wave 2, and these are in green. These are minors, by the way, and you'll see that when I bring in our longer model. And then we're currently in wave 3. Now, within wave 3, we've then subdivided this minor count into its components, and I believe what we've seen is a 1, a 2, a 3. We've seen our 4, and I believe we are currently in wave 5 out of 3, so it would conclude in terms of a count this minor 3, this being the minor 2 right here, a minor 3. I still believe that minor 3 is probably going to take us in terms of our upside target to over $1,400 per ounce, and that's simply based upon this wave 5 being about equal to this wave 1. Now, that being said, how do we kind of factor in what we've seen in terms of recent activity, specifically today's activity? Let me go ahead and kind of blow this up a little bit and scale it a little bit better. And so what I've done to actually calculate whether or not we've seen long-term damage is long-term damage, assuming that this is our wave 5 out of our minor 3. And if it's headed up, it's typically not going to go straight up, obviously. And so when we get these types of corrections, the key that we want to look at is it in the confines of a proper correction. Proper correction is anywhere between 38 and 61% retracement. It can go as high as 78, although that's not what you want to see, but you really don't want to see it go past 61. So we've got this spike up, which comes in at around 1310, trades to a high of 1371. And if you recall from the last couple of days, this is what really prompted me to raise the stops, was the fact that we were coming up to this point but not able to take it out. We didn't have that solid breakout above it. That's when we actually raised our stops. But look at this. When we calculate the amount of this correction, our 50% comes in at 42 and our 61% would come in at 35. So as long as this market, even if it trades under pressure at the beginning of the week, but as long as it stays above this 61% retracement, my sense is we haven't incurred any kind of long-term damage. So traders, as I said, the last chart that we looked at was really our shorter term count. This is really what I call our long count. We're creating it using a weekly chart, first of all. Now, this happens to be in Japanese average format. The reason I like to use Japanese average format, especially for a long count, is you can clearly see in many instances how these waves, solid red, for example, solid green, solid red, solid green, solid red, you get a little bit of a mixed bag here. But as you can see, what this really does is it isolates where these wave counts should be based upon the averages also. Now, what you'll see in this chart is the following. Obviously, back in 2011, when we hit these record tops, we hit a 5 out of 5 and we concluded a major fifth. There can be no doubt about that because that is the record high in gold. From there, we went into a long extended corrective period, and I believe that that corrective period in terms of our Elliott wave count was simply this long protracted major A. And I also believe, and that's what these last profitable trades, not so much this last one we did this week, but I mean the 6 to 8 trades we've done this year, why we've been able to get about a 300% return on our investment is because it was all predicated under the assumption that we had concluded a major A, intermediate fifth, minor fifth, and we're now headed into a counter wave, which is a B wave following this long wave down. And as you can see, we've got our count that goes in. In essence, we have wave 1, wave 2, wave 3. We've gone through our wave 4, and then finally our 5th wave out of 5, concluding our A. That takes us to what we've been looking at in detail, which is the short count. And on the short count, what we're really looking at is our wave 1. Again, this, of course, being a minor count right in here. The greens are definitely minors. We had our wave 2, and we are now within our wave 3. Our forecast for wave 3 is going to be over 1,400. Now, here's where it gets interesting, but here's where I'm also taking some real latitude because we're making some assumptions that certainly have not occurred yet. But bear with me and realize that this is one of many possible models, but I thought it warrants our attention, especially the fact that this is the weekend review. And after a day like today, I really want to focus on that big picture and not the minute activity that goes on. But the way that I'm looking at it as a potential model is our wave 1, our wave 2. We know that we're in wave 3. Let's assume that wave 3 concludes with wave 1 and wave 5 being equal. That all part and parcel of this. We would then go into some sort of a 4th wave. And what I've done is I've calculated various levels of retracement. 38 Of course, there's a 61 behind this. I believe that comes in at 2080, but I've taken it to a 50%. In other words, a mid-range, meaning that we'll see this market break above 1400, come back down, find support at around 1320, and then this calculation of this fifth wave here, which completes our wave one, is based upon a one-to-one relationship between 1 and 5. That, of course, would conclude this 1, and that would be a small a to this B. And, of course, this B is going to be composed of something like an A, a B, and then our final C. And in terms of where that final C could go, we're far too early to calculate that. But traders, this is my long-term model. And as you can see, today's information, today's new data certainly has not changed that model, and it has not affected our long-term strategies. An incredible ending to the week, and as we said, a jobs report well past expectation, really alluding to the fact that the economy and the growth is stronger than anticipated. 191-point gain in the Dow Jones Industrial Average, closing at 18,543. That, of course, is not a record top, but a very respectable move to the upside. However, Standard & Poor's, this is the E-mini, closing in record territory, 2176, and the NASDAQ also closing in record territory on the day. Whereas we had an extremely weak finish for the precious metals, we certainly had an incredible finish for U.S. equities. Dow Jones Industrial Average, however, did not close above its record top. You can see that on these daily charts. Here's our record top here. Here's the tremendous upside move we saw today. However, Standard & Poor's did break above those tops. We are looking at a daily chart in the Standard & Poor's. This, of course, is the E-mini. When we look at that, what we've been talking about all week is this really strong headwinds that we have seen in the market, really providing real resistance in the market. I really do believe that this report today has not only taken us to new highs, but we could be in store for a genuine breakout. I'm going to target a longer-term view of the market at about 2,200 on the Standard & Poor's. Traders, no doubt, strong U.S. dollar absolutely giving some downside pressure to the precious metals market, specifically gold, of course, as we said, off about $25. But the interesting fact is when we look at the Kitco Gold Index, which of course breaks apart a relative trading strength or weakness and dollar strength or weakness, what we see is that of that $25, $17 is directly accountable to selling in the gold market, with only about $7 related to a strong U.S. dollar. You can see the U.S. dollar here, 96.25, up 0.5% on the day. And finally, a quick look at crude oil. Crude oil trading below 42, but it is trading in essence unchanged on the day. Now, traders, as you know, we have been on record looking for crude oil prices to absolutely head lower. We've been saying that ever since this market's been tracking above 50. Our initial target was between $44 and $42 per barrel. They were Fibonacci-based numbers, of course, this 42 being a 61% retracement, and that retracement is from the move of $26 up to almost $52, and then we can plot the different subsequent retracement points. No doubt, once this market actually broke through 42, the next real target that we put into play was a 50% retracement at 38.93. Let me draw this line over as best I can. And you can absolutely see that trading activity this week, this is a daily chart, took us to these lows. These lows held, and I believe on a technical basis, this is where we have support. The real question is, will we see this $42 per barrel become resistance? My call on crude oil is sideways to lower trading activity next week. Traders, absolutely no doubt, a dramatic ending to the week. Tremendous downside pressure in the precious metals, specifically gold. It caused our stop to get hit. I'm certainly not happy about that. What I am pleased with is that the stop was there to protect us from taking any kind of a drawdown, and rather than losing money on the trade, we made a couple of dollars. Of course, the market was a lot higher yesterday and at the beginning of the day had we pulled profits. But the one thing that we have to realize is that when you get a fundamental change in news, even the techniques that we use, which are basically hybrid techniques combining fundamental analysis with technical analysis, it's not until that new data comes out that the market can react to it. So all we can really do is position ourselves for that. That being said, we did pull a small profit out of the market in gold on our current trade one. Secondly, I don't believe we incurred any long-term technical chart damage when we look at our gold chart. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye. At around 1371, and as I said, closed off about 2